Hello, Steve Lentz here with Discover Options. Welcome to this presentation of three different market timing reports for the S&P 500 market for advanced options traders. This is for Friday, August 24th, getting ready for Monday the 27th. Presented material is for educational purposes only, should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. So all three reports pertain to our current market condition. And we define that in three dimensions: price action, trend, and the stochastic situation. And so in terms of price action, we have an outside bar on Thursday, followed by an upswing bar on Friday. That all occurred while we are above the 50-day simple moving average, so it's trending upward. And then in terms of our 15-3 stochastic, it is between 60 and 100 in an uptrend, trading or measuring above its 3-day %D. All this makes for a fairly unique market condition, mostly because of that outside bar on Thursday. But this condition has only occurred about 71 times since January of 2000. Okay, so that's not too often, so keep that in mind. Let's go to the first report, and this again is for advanced options traders trading condors and butterflies. So since Jan of 2000, we've had roughly 4,698 daily closes of the S&P 500. Now, of those, 65.1% have been favorable bars for selling options premium, where the actual subsequent 21 bar movement of the index was less than what was being implied by the option prices. Okay, so almost 2/3 of the time, the market does not move as much as what the option prices are implying, and that's a good thing if you're putting butters and condors on. Now let's look at our 71 times here. Also during that time, our condition has occurred 71 times. Of those 71, 69% of the bars were similarly favorable for premium selling. That's more than our benchmark of 65.1. So we then have a option premium selling edge of 3.9% in this contest. Statistically, it's more likely than usual that this current market condition will end up being a favorable one for market neutral option premium selling. Okay, let's go to the bull put spread report. This is for those that like to sell puts in the S&Ps in a bullish manner, of course, where you're selling out of the money put premium, a standard deviation out, about 30 days in terms of expiry or so. 30 days, one standard deviation. That's the premise here. And of course, if the market moves down and hits your short strike, a standard deviation away, well, we presume you're going to get out for a loss. That would be the very latest time you'd want to get out at that point. So since Jan of 2000, as I mentioned, we've had 4,698 daily closes. Of those, 83.1 have been favorable bars for selling put premium, like what I described, where the actual 21 bar downside movement was less than what was being implied by the CBOE's skew adjusted VIX to the downside. Okay, so 83.1 is our benchmark. Now also during that time, okay, we've had 71 occurrences of this market condition. Of those 71, 81.7% of the bars were similarly favorable. That's less than our benchmark by a little bit, by about 1.4%. So we have a negative edge here. Statistically, it's slightly more likely than usual that today's condition will end up being an unfavorable one for selling out of the money put premium. Okay, finally we go to the likelihood report. This is where we measure the average rates of change given the history here. So if you go back to Jan of 2000, okay, on average, the market every 5 days has gone up 0.1% on average. Now we've had bullish seasons and some bearish, but all in all, the market has gone up since Jan of 2000. The average 2-week rate of change, one close here, go 2 weeks in the future, on average from each close looking forward 2 weeks or 10 days, 0.2%, about 1/5% to the upside, and a 3-week change, not quite 1/3% at 0.30. So that's our benchmark rates of change, and you can see those right up here. Now let's go to our current market condition. as of the close, and we can see that of those 71 occurrences, like over here, the average 5-day rate of change for those 71 turned out to be plus 0.15%. Okay, 0.15 instead of 0.10. That's a difference of 0.05. And when you divide that by the standard deviation, you get a z-score of only 6% of a standard deviation of the upside. Not a big difference. Not much of a difference at all. The 2-week rate of change turned out to be only 0.07%. That's less than the 1/5 of a percent at 0.2. So that's a negative difference. Our z-score is about 11% to the downside. Our 3-week z-score is about 5% of a standard deviation to the downside. So nothing to write home about here. Nothing huge at all to get excited about. Now, we divided these 71 up by those occurrences whereby the market went above the previous day's high. In this case, Friday's high. So Monday, if it goes above Friday's high, we have this to look at. So that occurred 44 times since Jan of 2000. On average, the 5-day rate of change was at 0.68. Look at that, 0.68 of a percent. Much, much higher than 0.1, right? So that's a difference of about 0.57 divided by that standard deviation. Our z-score puts us at about 71% of a standard deviation to the upside. That's pretty good. That's definitely leaning to the upside here. Our 2-week z-score dropped to 0.26, about 1/4 of a standard deviation, and our 3-week z-score is at about 1/5 of a standard deviation to the upside. So in the short term, we have something to really write home about. And likewise on the downside, if the market goes down below Friday's low, okay, that occurred 26 times since Jan of 2000. Our 1-week z-score is at almost 0.8, almost 80%. It's at 79% of a standard deviation to the downside. So definitely a bearish bias. 2-week and 3-week goes to 32% of a standard deviation and 25% of a standard deviation. So what you're looking at here is the motto here is watch Monday's action. If it goes above Friday's high, you historically you have a behavior that's quite bullish in the short term, especially. If it goes below Friday's low, same thing on the downside. You have some history here that shows some pretty good, especially in the short term, some downside bearish likelihood here. In terms of volatility, on average, the market, let's click here. The market basically typically is at 15.5 to 16% on an annualized basis. That's what the volatility typically is. Okay, our current market condition generates a realized volatility in the 12s, going up to 13 or so. And of course, dividing it up to the upside or downside, it's a huge. If it goes up, we're only in the 10s or 11s. If it goes down, now we're having a realized volatility in the 15s going up to 16. A dramatic realized volatility difference here. So keep that in mind. Currently, the VIX is at 11.99. That's less than what the prediction is just as of the close. That certainly is not enough premium to warrant anything going to the downside. But look at this. If the market does go up, the realized volatility is less than what the VIX is trading at. So that kind of is where we're at this point. Folks, I hope this has been helpful. I'm Steve Lentz with Discover Options. Have a great week trading. Take care. Bye-bye.